Hello guys, welcome back to my YouTube channel Option Behavior. So today we are gonna discuss about option buying, okay, direction option buying. But as we know that in buying options, right, there is a risk of losing premiums, whatever we are paying, right, whether be it monthly or weekly expiry, but we have to pay some premium if we are buying options. But if we are really sure about a certain movement in the market or the underlying that you are expecting to fall or rise, that depends on your view. So what kind of hedging we should actually make, so that at least since you are expecting the underlying to, say suppose that is supposed to be falling down, okay, if you are having that expectation, okay, so what is going to happen is um, since your view is positional, means this say suppose nifty, if it is if you are expecting this to fall, okay, but not on intraday basis, maybe in few days, maybe in couple of days or 3 days or in a week or so, right? So in that, what happens is we always have a very high risk of losing the premiums. The reason is if the market doesn't move in the direction that we have taken our position, or maybe even if the uh, underlying stays at the same level, or even at even in case of the crashing VIX, okay, the volatility if that decreases drastically, right? So in that case also the premium is lost. So how should avoid that? And even you will have to, I mean, since you are much sure about the direction of the underlying, right? So what should we do in that case, right? So guys, even that can be hedged to a certain level. I would not say that it can be completely hedged, but at least it will not give you that emotional losses that you might see on your screen if your underlying or if any indices does not move in your direction, or maybe that might move after some period of time, but you should not be having that regret. Oh my God, if I would have kept these positions for at least couple of days, then I would have got good amount or return, right? But so that just to control your emotion or just to keep things away, okay, so that whatever you are expecting, and if you are completely right, it is surely gonna give, but certain period of time it takes away. So for that purpose, I've just I'm just trying to make this video so that you can guys take benefit of it, and you can uh, hedge your positions to a certain extent. So for example, okay, so for example, I'm just giving an example in my case, like as per my indicator or setup, right? You could be having yours and whatever you are using as per your indicator, which indicates you that a specific or a specific stock or underlying, may go in a specific direction. So for that purpose, I have applied this Nifty over my setup. So I am expecting this to, go down. So actually, I have a bearish view. Okay, I have a bearish view, for example, okay, on 16th of November, okay, around 18,000. That I was seeing a tough resistance over there, and I was realizing the selling pressure at that point, at that level of Nifty. So I was making a bearish view, but since this chart that I have applied is on a daily basis, as you can see here, right? This is a daily chart. So, but in a day, the market doesn't fall directly, right? Even if your view is correct, like sometimes uh, it will fall, then again it will come to the same level, right? And then again it may start falling, and it might again come to the previous level. So the market behaves in a zigzag way. So what would happen is if I would have taken 18,000 put option, okay, so it might give me a it may give me some profit, it might not. The reason is the if that depends on the momentum uh, on the market, right? And since we have taken the put position, so if the market doesn't fall suddenly, right, uh, you will not get that much profit, right? If it moves in a zigzag way, and since you are trading on a daily basis, so obviously there is a very high chance of losing your premiums, and thus your emotional loss will start. So what what could we do in this situation is, although you are completely right, maybe in a week or in a few days, your direction is obviously correct. As you can see, if I had made a view on 16 November, right? So it has fallen from 18,000 to, at least if I'm considering this candle, so 70,400. So I am getting a good point, guys. Okay, 600 points. But this, I mean, obviously, this could not come. This definitely would not have come in a, in a straight way, right? Because on intraday basis, on different multiple time frames, it might have risen up, it might have fallen again, it might have gone to the previous level, and the things would have happened in a zigzag way. So, but you are absolutely correct in terms of direction. So, how should we achieve, and how should we, take that? You know, like a firm decision. Okay, I want to stay on this position, but I should not be even losing my emotional control, right? So in that case, what we could do is we could simply hedge this position, okay, with some weekly selling. Now I'm going to explain you like what exactly you should sell and what exactly you should not. So in that way, you should be having at least, like intraday losses that might be displayed on your screen because of zigzag movement of the underlying. Uh, so in that case, at least uh, the weekly option that you would have say sold, okay. So that would have, I mean, that might be giving you some courage or some, like emotional control, uh, you know, uh, thing. So which will actually protect your capital, first of all, to a certain level, and even that will have your, I mean, that will keep you giving some courageous. Okay, like, okay, means even if the market is not moving, but even market is not rising, and even if it is not, even that is not crossing your level that we're expecting. So they should fall, they should fall. You should be having this mind, but since it doesn't happen the way that we expect it, rather it happens in a zigzag way. So in that scenario, your sold option would definitely be acting as as a very kind of very good support in terms of your emotional loss, right? So that would give you some comfort. So in that case, guys, okay. So let me go to Opstra, and we can see like what are the possible and what are the ways that we can do this hedging so that your loss could be minimized, and even obviously your profit will not be that much in case of free fall, right? Because if you just buy option, you will have that view that you can get unlimited profit, but who knows like when you are going to book profit, right? But still, at least your view is correct. You're gonna make money. That is absolutely correct. Nobody can take that money from you, right? So let me navigate to you, Opstra, and say suppose. So okay, that was just my view. But how the things look like when you actually plan your view? Okay, maybe we are in the month of December now. So say suppose again if I have that bearish view. Okay, just for example, I'm saying. Okay, it could be anything. You might have your bullish view also. So say suppose if you are having bearish view, so what? what I would suggest you? Okay, for example, um, you should buy some option. Okay, uh, put position. For example, you are having some uh, bearish view. Okay, and currently you can see Nifty is trading at around 17,200. So 17,200. So what should you do actually? Okay, what I would suggest you. Okay, you should buy the monthly option. Okay, although you will get some a bit expensive premium, but that is completely fine, guys. Okay, because you also have uh, some uh, some support that you're going to apply, okay, in this logic. And even if you are buying some monthly option, you are not, I mean, your premium whatever you have paid is not going to be zero immediately, right? At least that has to expire in a month, and so you would be having some time. You could I mean, you can keep selling your put weekly put options unless and until that your um, uh, level is not reached to the resistance or to the support, whatever it is, right? So in that case, you have the option of selling some weekly put option, so that even if your direction goes wrong, at least you would be getting some premium. Okay, so it is better to lose very less premium, right? Than losing it entirely. So if I am having a bearish view, so what I'm gonna do is I would be buying the monthly put option. Okay, so suppose I'm having bearish view in Nifty, so I would be buying 17,200 put option at the cost of 76. Okay, so let me add this position. Added this. Now what I would do is I would be selling a put option also in case the market doesn't move on the same day. Maybe it might move on next day, or maybe after few days. Okay, so in that case, at least I should be receiving some premium by selling different strikes of put option, but weekly. Okay, and in that case also, uh, uh, that will keep you emotionally intact. So what I would suggest you, so whatever strike that you have bought monthly, a monthly strike, right? So just you should get away 200 points from the option that we have bought. So I had bought 70,200. Now I'm gonna sell a weekly option of 17,000 put. So I am getting away 200 points. Okay. So in that case, I'm gonna at least receive 75 rupees as a premium, even if uh, the market doesn't move. So at least this particular amount would be giving me some level of profit. Okay, which is really uh, you know uh, essential to have, guys, so that uh, unless and until your direction doesn't move in some moment, right? At least this would be keeping me happy. Okay, so if I sell this position, this put option, okay, so what will happen is, okay, and since here we are making a position of both the combination of monthly and weekly, so whatever the graph that is shown over here, okay, that is not actually the correct one, because it calculates its data, the profit and loss data, depending on its, it thinks that, okay, both the options are going to expire, but this is not the case. If you know the basic option, right? So monthly option is not gonna expire in a week, right? It has to go a long way, right? So this graph, okay, so although it is showing, okay, that market, say suppose if it crosses here, then you're gonna lose, you're going to make this much of losses, but actually this is not a correct loss, because it calculates the data depending on uh, you know uh, it has that logic inbuilt in it, behaves in a way that both the options are going to expire on the same day, but this is not the case. Even if you are seeing some losses over here, for example, if it crosses over here, okay, and it is showing the loss of 2,900, but this is not the actual loss, because obviously in the monthly option you would be having some premium. right? That is not going to be completely zero. Okay, and so that is another part. Second, so that is another beauty of this strategy. And the second thing is, if since your direction was correct, if it moves in your direction, and guys, just think, so suppose if it moves just 200 points and it takes 1 week of time, okay, uh, or maybe maybe 400 points, if it takes a movement of 400 points, okay, also say suppose 300 points, so suppose 16,900, I'm just making it, okay, so what is showing is, it is showing around 5,800 profit, but actually you will be getting more profit. Okay, the reason is, monthly option obviously it would have gained a very good amount of premiums, okay, as the market is falling down, and that option is gonna expire on its time, right, on its expiry day. So I would have, I mean, since I have bought I have sold an option of premium 75 rupees, okay, and the market has moved down to, you know, 400 points. The movements have already happened, okay. So in that case, if it expires at 16,900, okay, so this weekly put option would be, would be standing at around, or would be expiring at 100 rupees, right? If you know uh, mathematics of option, like how does it expire and at what value it should expire and when it should become zero, if you have that basic knowledge, so you can understand like why it would be standing at rupees 100. So even if it stands at rupees 100, right, we are just losing 25 points over here, because we have already gained and we have already got 75 premiums, right? And currently it is expiring at 100 rupees, so we are losing just 25 points. But guys, since nifty has nifty itself has moved down to about 400 points, that means whatever you have bought the option, right, which you have bought as 276 rupees, even if I do not consider any theta value over here, right? The cost of the premium of this specific strike would be 400, okay, which is 125 points. That means even if I consider that it has left its theta completely, which is actually not correct at all, it would at least have, you know, 100 of premium. I mean, uh, the extrinsic value, okay. It would definitely have 100 rupees of premium as extrinsic value. That means instead of uh, it should be means logically it should be 400, but actually it should not be. It will not happen that way. It will have some premiums. It will have some extrinsic value. So it would be around 500 instead of 400. So there, guys, you are almost going to make, even if I subtract that 25 points loss, then at least you would be getting 200 points. So that is what I was about to explain, that Obstra is showing you that you are going to just make 5,000 or 5,500, but actually you're gonna make 10,000, because Obstra thinks that both the options are gonna expire in 1 week. But you you guys are much clever, right? That monthly option doesn't expire on weekly basis. So in that case, guys, you are really gonna make a very good amount of money. And since your uh, underlying moves in a zigzag way, okay, you will see profit in both the options. That I can guarantee, guys. And that moment of, you would be really happy. Even if you are gaining 50 points, na, you would be having that emotional control. Oh my God, at least I'm having 50 points, 30 points from the main option and 20 points from the sold option. Because the market is not moving suddenly in my direction. It is moving, but uh, It is falling, then again rising. It is falling, then again rising. So in that way, you know, weekly option weekly option has the tendency to lose its premium faster than monthly ones because the theta is impacting and the expiry time is coming much faster than the monthly one. So if you know the option behavior and its calculation, you would understand my point. So guys, option trading is not that much difficult. Even option buying is not that much, you we should not be having uh, that effort in our mind, okay, like that fear in our mind, okay, if I buy option then I can lose it completely. No guys, if you have some strategic, if you have some specific plan, then obviously it's not that easy for market to give you losses. So in that case, guys, you can you can really make money following this strategy. And I would not recommend it, to just go 100 points away from the bought option, okay, because that would not give you that much profit. So I would recommend to have 200 points distance from the option that we have bought, so that at least it should be giving a bigger room to move towards your direction. Okay, and okay, guys. So just plan your option buying depending on the strategy. I'm sure that you will surely gonna make money. And say suppose, guys, even if your direction goes wrong, so there are two ways to do. Okay, I mean, say suppose whatever the analysis that you have done, okay, as you can see from my indicator, okay, that this has given a sell signal, and this is still in sell position, okay. So what will happen is um, uh, this surely gonna give you profit, but maybe if that gets converted into a buy signal, okay. So there are two ways. Either, I mean, the best part is you should take your stop loss depending on your chart and depending on your appetite and risk and reward ratio or position sizing. That depends on you, okay? Because option buying is easier than selling, but when you lose, when people start losing their premium, they think, okay, if we just average at this price at such a low price, then I can earn a lot. But that doesn't happen, guys. Okay, and but what I'm saying, what I wanted to explain is, if your direction goes wrong, so there are two options for you guys. One is to cut down your losses and just book the losses and exit from the trade. Second thing is, since you have bought the monthly position, right? Monthly options. What you can like, what you should be doing is, if the sold put option, right, if that becomes 10 rupees or 8 rupees, and you have come to know, okay, this is not going to, now the market has changed its direction completely. So what you should do, you should again sell, you know, maybe 100 point inside of whatever you have sold. Say suppose you have sold 70,000 put. Okay, so now you should move. You should sell one put option. Okay, from the coming expiry, maybe 16 December. Okay, and that too you will not sell off 17,000. Rather you should sell 16,900. So that you will be getting some good premiums. So in that way also you could manage and you can minimize your losses. So, but you should not be, coming and aggressively, and you should sell some 70,100 put option, right? Because if again market reverses, then that's gonna give you huge losses. So don't do that. Just move 100 points, upside from your current position and move to next week so that you can sell the next week put option and you can still get some premiums, because again that is gonna expire worthless. Okay, the weekly one and monthly one definitely would have some premium. So at least you would be getting some premium. So that is just another way. I'm not suggesting that, but at least if maybe on intraday basis, if you again get that view, okay, that is again it is reversing back to the same direction that you have thought of. So again you can make money. So there are two options and two ways that you can manage your position. So that depends on you. But I would suggest guys, do not ever go naked in buying options, because there is high probability of losing your premiums. Okay, although you might see a very good movement in the market in your direction, and you might think, hey, this guy told me not to go naked option. See, I would have made this much of money. But guys, this would happen, uh, very few days in your life. Okay, and that will take away everything from you. But if you have some proper plan, some proper strategy, then definitely you will have the ability to sustain in the market. Okay, if you are gaining something market, gaining some amount, if you are really expecting some return from the market, okay, then definitely you will have to stick to some specific plan, some strategies, okay, some logic behind buying or selling options. Then only you can survive. If you really want to make this option buying or selling as as your maybe as your uh, career, or maybe you want to really make money out of this, so you will have to go ahead with some specific plan, guys, because if you just come with some amount of money and just if you just lose it and you again borrow some money from someone or from bank, and again you come and lose here, so there is no point in making such things. So that is what I wanted to explain, guys, and this is how you should be buying option. That is that way you should be at least all also protecting your capital, that will keep you emotionally stable. So this is how you should plan something. Guys, thanks a lot for watching this video. Please do like, subscribe, and uh, share it with everyone. Thank you.